This non-logarithmic S&P 500 chart was snapshot on the close of February 21st, 2025 at just over 6,000, effective nominally doubling in numbers since the COVID 2020 infinite QE and low-rate refinancing orgy of the time. The Trump administration's tariff threats and uncertainty tremors have begun lightly hemorrhaging the U.S. stock and crypto market bubbles, but this recent drop is actually nothing yet. If things go real wrong this year, seeing the S&P 500 cut in half nominally would not be out of the historic norm for stock bear markets during recessions. Now, shortly, we're going to take a longer-term look at the U.S. stock market value versus bullion over a long period of time. But first, I want you to hear from the U.S. Treasury Secretary speaking today about what the administration is supposedly driving at big picture.
Can you just make the case that when we come out on the other side of this, we're going to say, wow, it was really, really worth it? I think you started to do that yesterday. You started to talk about what that looks like. Can you fill in some of the blanks on how you see this playing out?
Sure, Joe. And I don't think it's a radical change. It's just a much-needed course adjustment. And when we go back and look at what's happened, there's a new paper out called the China Shock. And it talks about what happened post-2004, that some of the communities recovered, but the workers never recovered. And that it was much more devastating on a human level. And what we are trying to do is make free trade fair trade, because the trading systems have become incredibly imbalanced. You see it with these the trade deficits that we run. You see it with the big surpluses that other countries are accumulating. So we're looking at tariff barriers, non-tariff barriers, currency manipulation, government subsidies, and in the EU, some of these gigantic fines that they're putting on our tech companies just because they see a big pool of capital. And we're going to push back on those. And at the end of the day, President Trump's been saying tariff is his favorite word. I think reciprocal may be his second favorite word. And we're going to put this at the feet of our trading partners on April 2nd. We're going to come out, talk about who's a good actor, who's a bad actor, to what degree they have put up barriers against us, and it'll be a choice. Either they can drop all the market manipulation and things like that they've done that have hurt American workers. And if they do that, then we could have more frictionless trade, or we'll put up the tariff wall, we'll collect a lot of money, and we will make the system fairer.
A couple of things. I think you've made the point that unlike the printing of too much fiat currency, which might be an underlying cause of inflation, the tariffs don't cause long-term inflation. They could cause some price increases, but not long-term. But then at the same time, you said that Americans don't necessarily just want everything to be really cheap. They want our workers to be employed here. And that the prosperity here doesn't mean being able to buy cheap goods. It means being able to live the American dream through having a job and having a future, et cetera. So we're going to have higher input costs forever.
So what, higher input costs forever? No, it's the tariffs are a one-time price adjustment, and everything else the administration's doing we're not getting much credit. As of yesterday, energy prices were down 15%. Crude was down 15% since Inauguration Day. 10-year rates are down, mortgages are down. The spreads between the 10-year rate and mortgages have come in. So we saw we saw mortgage applications pop up last week. I think if we can keep on that trajectory, and Joe, the American dream is to be able to buy a house. We can't import houses.
But this could all be a reflection of the economy slowing down.
As an investor who used to spend their day investing in all of this stuff, do you look at the 10-year, do you look at all of the signs you just talked about, WTI and everything else, and say that is the work of the government and a newfound confidence in what's happening to the economy, or that's actually a concern about what's going to happen to the economy?
Well, I think it's both, because we could have the worst of all worlds, because, look, and I'm not new to this. When I was on your show last time, I've been saying it for 6 or 9 months. I believe that the Biden administration, and it's back to Joe's question, on working Americans and what is the American dream. But the Biden administration created this bad equilibrium where the top 10%, people in this room, probably most of the people watching this show, top 10% of Americans are 40 or 50% of consumption. And that is an unstable equilibrium. The bottom 50% of working Americans have gotten killed. We are trying to address that. We're trying to get rates down. And could we be seeing that this economy that we inherited starting to roll a bit? Sure. And look, there's going to be a natural adjustment as we move away from public spending to private spending. The market and the economy have just become hooked. We've become addicted to this government spending, and there's going to be a detox period. There's going to be a detox period.
I think that temporary pain that you've acknowledged, that the president has acknowledged, I think the question becomes, is temporary pain the new transitory inflation? How do you know that we get to the other side of this, and how long do you think it actually takes?
Well, look, there's an adjustment. We'll see whether there's pain. What we are trying to do, I talked about it at the Economic Club of New York yesterday, we are trying to transition from public to private. I talked about we are going to have safe and sound regulation to get our banking system going again. So the banks should be generating loans to private companies. Employment should be from private companies, not from government. And I'm confident if we have the right policies, it'll be a very smooth transition.
Now, President Trump was asked about the recent drop in the U.S. stock market. His answer this week for me was sell, 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 take profits, and not confidence inspiring.
Mr. President, what are you making of the market sell-off this week?
I think it's globalists that see how rich our country's going to be, and they don't like it. There's a big market out there. But again, they've been ripping off this country for years, and they're going to do great. Everyone's going to do great. But we can't let this continue to happen to America. Otherwise, we're not going to have a country any longer. Thank you very much, everybody.
Let's quickly remind ourselves what candidate Trump said during his presidential run in late September 2016, back when the S&P 500 was nominally just over one-third where it is today.
We have the worst revival of an economy since the Great Depression. And believe me, we're in a bubble right now. And the only thing that looks good is the stock market. But if you raise interest rates even a little bit, that's going to come crashing down. We are in a big, fat, ugly bubble. And we better be awfully careful. And we have a Fed that's doing political things. This Janet Yellen of the Fed. The Fed is doing political by keeping the interest rates at this level.
Now, I'm not saying the S&P 500 is about to draw down back toward its later 2016 nominal levels. Matter of fact, infinite QE policies are unlikely to allow that. What I am saying is that relative to gold and silver bullion prices, it's still at eye-wateringly high relative historic levels. Now, my long-term bet is gold, silver bullion outperforming the U.S. stock market is due to not only roll back down on these charts towards the 2011 spike lows, but then eventually beyond lower as the world comes to terms with just how delusional most asset class values are at the moment. Back to ongoing tariff headline chaos, Louis Vincent Gabe of Gavekal Global Macro and Market Research had some intelligent takes this week on CNBC India. Let's have a listen to what he had to say.
The Canada-Mexico tariffs and, of course, the 10% extra tariffs on China, they seem to be motivated by essentially stopping the flow of illegal drugs into the U.S., right? It's not to raise revenues, at least that's not the stated objective. So is this going to off-ramp at some point, or you think this is here to stay, these tariffs particularly?
I think you put your finger on it. The big question is, are the tariffs a tool towards achieving something, or are they the end goal? I think so far, there's still a lot of signs that Trump is looking at tariffs like a tool to achieve something else. Now, fundamentally, what does Trump really want to achieve? I think the first goal right now, what seems pretty obvious, at least to me, is that contrary to Trump 1.0, who kept tweeting about the stock market making new highs, and what they're really worried most about is three things. They want to get the bond yield down, they want to get the US dollar down, and they want to get the oil price down. And pretty much every one of these policies that they've implemented, now there's other things, yes, they want to stop the drug flow, et cetera, but everything they're implementing is really driven by these three goals, and including the tariffs. For me, and I could be wrong on this because it's very hard to predict what Trump is going to do next, but for me, the tariffs remain a tool. And it's a tool that you're going to use to beat up America's trade partners, whether Japan, whether Korea, whether China, and to say, look, guys, I'm going to tariff you unless you go out and you buy U.S. treasuries and unless you raise the value of your currency. I think the next few months we get a lot of this until basically Xi Jinping and Trump meet in May, and then we'll have a better outlook on whether tariffs are here to stay, or whether some kind of Mar-a-Lago Accord, to use Scott Bessent's term, whether some kind of Mar-a-Lago Accord gets achieved.
Are the three things you mentioned consistent with a higher stock market?
I don't think it's as much of a priority, to be honest.
That's an interesting, important point, because, I mean, the general assumption is that he's very focused on the Dow being at a new high. It's like a point of pride. But you're saying actually the target this time is not higher stock markets, it's lower cost of borrowing.
I think so. You'll notice this time he hasn't tweeted once on the level of the stock market.
Okay.
You've had tweets from Elon Musk, you've had talks from J.D. Vance, from Scott Bessent, from Trump himself on the 10-year yield. And I think the reason for that is actually the setup today in the U.S. is completely different.
Yeah.
The big problem is in the second half of this year, you have a massive amount of debt to roll over. Because remember, in the second half of 2020, interest rates were at record lows. Every single U.S. corporate went out and issued debt. You know, when interest rates were below 2%, you're a CFO of a company, it'd be criminal not to issue debt. They all did it, and most of corporate debt in the U.S. is 5 years. So now, these guys all have to roll over the debt in the second half of 2025. If they roll over at much higher rates, that means that CapEx is going to get cuts. That means that employment is going to get cut to pay for the debt. They have to get the cost of debt down. Without that, you're facing a really bad 26, and guess what happens in 26? Midterm elections. So take the pain up front, get the lower interest rates so that the economy can be rebounding by 26 on the back of lower energy and lower interest rate costs.
Okay. Here are his entire takes from the entire backlinked interview in the show notes below. Now, if the aim at the bottom of the highlights here is to have the U.S. economy rebounding by 2026 in time for the next major elections, well, I'll be shorting and hedging that bet in real terms with heavy positions in bullion continued. We're coming off one of the fattest, ugly bubble markets ever concocted and propped up in financial history in the United States. The idea that this game plan is going to run smoothly, giving all factors we regularly cover here, well, it's pure hopium. So good luck. Give me the bullion. Hello there, this is James Anderson on behalf of SD Bullion with your weekly bullion market update. Please smash the like button, subscribe, and share this content with those who also might find value. Before we continue with this week's bullion price action and other news, a quick reminder about SD Bullion's new IRA streamlining service offering.
You know, traditionally, you got your dealer, your custodian, your depository.
The reason why ours is so good, first of all, we're two of those three parties, right? We have the depository, we're the retailer. The only thing we're not is the custodian. We don't get any negative experience from the customer because of how fast things are going. Who you pick is incredibly important. SD Bullion, we're different.
The silver and gold markets rose on the week. The spot silver price finished at $32.48 an ounce bid. The spot gold price closed at $2,911 an ounce bid. The spot gold silver ratio ended down at 89. More on that still stubbornly high ratio a bit later in this week's update. One take by a long time respected silver bull that I'm sure many of you will likely agree with. But first, some data updates on the week. London gold-silver numbers keep falling, updated today through last month, February 2025. Spread out amongst the City of London's vaults and unsecured ETF holdings, both gold and silver levels fell again. The London gold delivery delay default story is not as acute as the current London silver situation. Instead of gold lending by governments to commercial banks, there are no central bank last resort silver lenders. Accordingly, London silver float estimates are now down to a record level of 170.5 million ounces sitting free and clear outside the unsecured silver ETFs, which of course will continue being rated as silver demand push-shove gets going in earnest in the years to come. Last month's silver pull from London represented an over negative 18% drawdown of London float silver allegedly available at high lease rates and potential borrowing costs climbing. With the now near 100 million ounce inflow of silver bullion into the COMEX silver warehouse inventories over the last few months, TD Securities' Daniel Galley continues banging the table that a critical threshold of available silver in the London silver market is growing closer to being breached for the market to function. He's not the only analyst saying akin. Former bullion bank trading heads are echoing his takes, reminding onlookers to stay locked in on tightening silver supplies and climbing London lease rates. Remember that on daily business day basis, nearly 250 million ounces of paper silver derivatives trade in London, which is well above the threshold of floating available silver bullion underlying that over-leveraged price discovery market. Now cut to silver industry spokesgroup the Silver Institute this week, which republished front and center a doozy of a report, stating with a headline, quote, "Majority of above-ground silver stocks or inventories are unavailable to the market regardless of price." Now I'll leave a link to that report in the show notes below. But probably the biggest doozy of their 55-year study was the following admission of derivatives running the global silver price discovery markets. Quote, "There appears to be no correlation between the price of silver and above-ground stocks." In other words, supply and demand physically did not matter in the 1980 bull run, nor the early 2011 bull run. They were more so investment-driven bull markets, and I would argue levered longs in derivative markets like COMEX silver futures were on a winning streak, likely catching wrong-sided shorts and taking them to the cleaners. Will supply and demand ever matter in the global silver price discovery markets? Well, I'm not sure. Does it matter? Probably, but it might only be after a manic price climb in silver prices, where the market eventually finds a better balance between the persistent deficits we have seen over the last 5 years or so and the likely decade to come, given current demand forecasts looking out into the future. It's, after all, phony price rigging that has created this global silver price divergence, climbing walls over the last 5 years. Now, for this to come back in line, it's likely going to require a magical move for silver to come, be it driven by underlying fundamentals or derivatives blowing back in the faces of artificial price signals that have been running for decades. I know, to unstudied normies out there, this all sounds silver nutballish, but we're talking about the biggest uncovered debt binge in the history of finance, and for gold and silver to go berserk again is merely history rhyming in time. But you don't need to take my word for it. Maybe instead listen to longtime silver bull and soon-to-be multi-fiat billionaire again, mine owner Eric Sprott, who, like many of us, suffered through the abysmal humiliation of the 2010s only to grow our positions more outsized and perhaps concentrated for this building bullion bull. Have a listen to his bullish silver bullion conviction commentary this week.
Eric, you're also known to have a penchant for silver, and you've been the biggest investor in the silver space in recent years. The silver market is in a sort of technical deficit. More is consumed than is produced from mining. What do you think is going to happen when industrial demand for silver, such as for solar, which grew about 27% last year, depletes the inventories historically used for investment and store of value?
I think silver is going to skyrocket. In my speech, I suggested that Michael Oliver, who writes the Momentum Structural Analysis, I think his ultimate target's 250 on silver.
250?
250, yeah. And I believe it. And there was another gentleman, Don Durrett, who analyzes small cap mining companies, and his target was 500. And I can see both being entirely possible here, because I know the targets on gold were like 8 to 10,000. Silver used to trade at 15 to 1 to gold. It's produced, Keith, you interviewed Keith Neumeyer. He said we only produce 7 ounces of silver for every ounce of gold. Why is the price 90 to 1? Because it's manipulated, been manipulated for the last 50 years. And those guys are all still short. They can't get off their shorts. the demand for silver in the March contract that just expired, which is open for delivery, not expired, but open for delivery, they nominate for 76 million ounces of silver for the March contract. We don't even produce 76 million ounces a month. But on COMEX, that never used to be a physical exchange, they're delivering a month's supply of silver. That's a new entrant in the game that already has a deficit of 200 million ounces. So there's just no doubt in my mind we will breach the resistance at 33 and we will just ultimately fly here.
You're talking about the sort of gold-silver ratio and how it's much wider than perhaps it should be. I mean, we go back 200, 250 years, Adam Smith and the Wealth of Nations, I think he said it's about 13 to 1, 15 to 1.
That's exactly what it was. Yeah.
Do you see that really contracting?
Yeah, that's what it should be. It should go to at least 15 to 1 or 12 to 1, which it was as a currency. It'll go lower if we're only producing 7 ounces of silver versus an ounce of gold. It could go to 7 to 1. It's probably going to overshoot one way or another once it breaks the entrapment that it's in.
There does seem to be sort of quite a few things that aren't going well or properly in the silver space. I think not too long ago it took 9 months for someone at Sprott to receive physical delivery of silver for a 5-day settlement contract. What are some of the things you think are wrong with the silver space or that need fixing?
Well, I think there's shortages. Guys are having tough times making deliveries. In fact, I'm a believer that when we all point out that SLV is losing ounces and this guy's losing ounces, I think it's the dealers and banks buying the shares and redeeming them to make delivery on the COMEX. That there's lots of demand for gold and silver. I mean, we get lineups in China and India and South Korea is running out of silver, and there's lots of demand in Europe. The demand is not as robust at the retail level in North America, but that can change in a dime. So I think once we break through 33, I think we'll have a big run here.
That will be all for our weekly SD Bullion Market update. And always to you out there, take great care of yourselves and those you love. If you enjoyed this video, hit the like button and share it with those you love. Subscribe to our channel and hit that alert button so you know when we publish new bullion market updates.